Welcome to the Lauder Institute at the University of Pennsylvania. I'm Jules van Binsbergen, director of the Institute and a finance professor at the Wharton School.
And I'm Jonathan Berk, a finance professor at the Graduate School of Business at Stanford University. This is the All Else Equal podcast. Welcome back, everybody. Today we're going to talk about private equity markets.
Private markets have grown a lot in the last couple of decades, not just on the private equity side, which we've seen grow by a lot, and we had an episode on that before, but also private debt markets, which means that private equity firms have increasingly started to give corporate loans to corporations. And the question is, why are private equity firms the right party, one, to hold these positions in firms on an equity side, but also on the debt side? Why are they the right party to provide these loans to corporations?
I think, Jules, a possible explanation is what I call the fundamental theorem of corporate finance. On the one hand, you could have a private firm run by a single entrepreneur. The firm will be very well run because the entrepreneur will have all of his assets in the firm and he'll look after the firm very well. But the downside is, because all of his assets are in the firm, he's very exposed to the idiosyncratic risk of the firm. So he takes on a lot of risk. The alternative is to run the firm as a public corporation with diversified shareholders, or shareholders that are diversified across lots of firms. So in that case, the shareholders of the firm are not holding idiosyncratic risk. But because there's so many of them, nobody's looking over anybody's shoulder. And so the firm is not as well run. And I call that the fundamental trade-off of corporate finance. And perhaps private equity can solve that trade-off.
Indeed. So private equity firms, what they generally do is that when they hold equity stakes in firms, they also provide board of directors to the board of the firm, which means that they're very actively and closely involved in the firm. And of course, the investors that want to have the diversification, they can invest their money with the private equity firm who already holds multiple firms. But in addition, these investors can hold stakes in multiple private equity firms, or even part of their money in private equity firms and the rest in public firms. And so in this way, you can get the monitoring services coming from the private equity firm, as well as the diversification where the investors are not particularly exposed to any individual firm.
Yeah, so it does seem as if this solves the problem. But of course, if the private equity firm has lots of portfolio companies, then there's a limit to how much monitoring they can do. And if the investors are invested in lots of private equity firms, there's a limit to how much monitoring the investors can do of the private equity firms. So perhaps we've just moved the problem further down the principal agent chain. Having said that, we do find in public markets the same intermediation. Today, most individuals don't hold individual shares. They hold shares through mutual funds. So there we see the same intermediation. So maybe it's just another example of the intermediation that's necessary to make financial markets work.
Absolutely. And so I think that one of the underlying assumptions that we have here is that for whatever reason, this monitoring of firms by investor is important. Right? If monitoring wasn't important, I don't think it would matter very much how you would do the intermediation. And so in many ways, I think that what the private equity and the private debt firms are selling is that they're better at this monitoring. They're better at collecting the relevant information to be able to do this type of monitoring. And therefore, this could potentially lead to a better allocation of resources compared to the alternative model where less of this monitoring would take place. But what also fascinates me, Jonathan, though, is that we've seen shifts back and forth between public markets to private markets. The trend in the last couple decades is the shift towards private markets. So if we wanted to have a rational explanation for why this is happening, and we stick with the theme that we just introduced, does this then mean that monitoring by private parties has become more important over the decades? And that's one of the reasons why we're seeing the shift. An alternative explanation that we've already introduced in a previous episode was, well, regulation in public markets has become so prohibitive and so difficult that has just pushed investors away from public markets towards private markets. But maybe there's also something to say for the argument that monitoring services have just become more valuable over time, maybe due to a change in the way the economy is organized or the types of firms that are currently dominant.
Yeah. And another issue, which I think is a big one in this space, is that in public markets, it's much easier, shall I say, to measure performance than it is in private markets. And, generally the data for private equity firms is all self-reported. So it's difficult to trust the data. But with that said, what's interesting is a dichotomy in academics. On the one hand, many academics look at public markets, look at the intermediaries, in other words, mutual funds, and are suspicious of those intermediaries. Many academics think they add very little value. Now, we've done podcasts on this, and our listeners should know that Jules and I disagree with that, and that we think our research shows the opposite, that the mutual funds add a lot of value and are performing a very good role as intermediaries. But what's interesting is the dominant view in academics of private markets is that the private market intermediaries do a great job, and they are adding a lot of value, even though the data is all self-reported. So there's no, sure, the data says they are doing well, but of course they report the data themselves. And so it's interesting to see academics be less suspicious of private markets than they are of public markets.
Absolutely. And I think that to compound that issue, how do you really evaluate whether a private equity fund is doing a good job? Suppose there wasn't even the data reporting problem. There's this other important issue, which is, what is the benchmark that you hold a private equity firm accountable against? In our mutual fund work, we've done quite a lot of work trying to make it clear how to construct a real-time available benchmark for investors that they could otherwise put their money in. But, if you would ask us to do that same thing for each private equity firm, I think we would have a pretty hard time really constructing a proper benchmark that we're very comfortable with. And if the benchmarking becomes hard, that allows for a large fudge factor in terms of trying to determine whether or not the private equity firm, in terms of performance, that did well or didn't do well. And so I think that, these are all issues that deserve a lot of research and a lot of work that hasn't been done yet, I think, and there's a lot of progress that could still be made there. But I think that one of the experts in the field on the academic side is our guest today, and we're very happy to have him on the podcast. His name is Ludovic Phalippou. He specializes in private equity and asset management and is the author of the bestseller, Private Equity Laid Bare. So I think it's important to note that Ludo has quite a critical view of private equity, particularly in the way that performance is being presented and performance is measured. And so he has made a lot of progress on this performance measurement issue, and we're very happy to have him with us today. Welcome, Ludo.
Thank you very much for having me.
So, Ludo, you're an expert on private markets, especially private equity and private debt. We've seen significant growth recently, and particularly in the recent decades. What do you see as the core economic or financial rationale for the existence of private markets? And we mean that question particularly in the context or the contrast between private markets and public markets. What is it that private markets can do that public markets can't, and vice versa?
Yeah, I would say that at the core, if you look at supply and demand side for capital, who are the suppliers of capital? It's mostly university endowments, pensions, your own savings. And what is it they would get out of public markets? The main thing that public markets does is to give you millisecond level liquidity, continuous trading, etc. You don't care. The endowment doesn't care. Most investors don't care about that. You can say, how about diversification? But private markets gives you a lot of diversification. If anything, much better diversification than public markets, who tend to have similar type of companies that are listed. And then you can say, well, investor protection. Well, the regulator, if they're so bothered, could regulate, have the same protection for private market participants as it does for public markets. So on the supply side, I would be as aggressive as saying that, it's the natural way in a modern economy is actually private markets. Like in the 16th century in the Netherlands, then maybe the markets were like more natural, but nowadays it's not clear. This is where the supply of capital will naturally find its habitat. And if you turn to demand, for a company, it makes quite a lot of sense to have management coming in, having their own money put into the business, having steep incentives aligned with their shareholder, and to turn around the company with a 5 years deadline. and getting paid only when they exit, when the cash is actually there, not based on an NAV or anything like that. It actually makes a lot of sense also on the demand side. And if a company doesn't need a turnaround, if it doesn't need like, an intervention to improve it, it's just buy and hold. Well, a family office can buy and hold companies, endowments, pension funds can buy and hold companies. You don't really need a public market even, for that. So even on the demand side, the private markets are quite natural.
So Ludo, as you know, I have a textbook, and in the textbook, we talk about what I call the fundamental trade-off of corporate finance. Basically, you trade off the benefit of risk diversification against the monitoring capabilities of a shareholder who holds a large stake but is not diversified. Are you saying that private equity markets solve this problem?
Yeah, I would say that you need to rewrite your textbook. So this is true for up until about 2000, I would say. At the turn of the century, there is the emergence of what I have called mega asset owners. You have like the Norwegians with $1 trillion, you have ADIA with $1 trillion, you have several people with $1 trillion to deploy. The Dutch pension fund, even APG, is close to $1 trillion US. You have lots of very large pockets of money. And so they can hold 1,000, 2,000 companies directly. They could hold the entire company. An example I give sometimes is the example of Hugo Boss. Hugo Boss in the mid-2000s was not doing that well. You have a private equity firm called Permira who takes it over, turns it around, takes them a bit of time. And then Hugo Boss is now a shop that is everywhere in any shopping mall in the world. You cannot really improve it in any way. And who holds Hugo Boss? Well, one family office in the Middle East. There is no reason for Hugo Boss to be held by 10,000 people. For this family office, Hugo Boss is one of 200, 300 companies in their portfolio. With 100, 200 positions, you're diversified. So yeah, I would challenge that. And on the fundamentals as well, on the private credit side, you can make the same arguments. Maybe banks were there, at a time when it was relevant. Nowadays, there's no reason. The banks, I think you said that in an earlier podcast, the banks are not natural lenders of long-term capital. And so these private credit funds, and now even directly we see pension funds making loans. They're the natural guys. The pension funds don't even want to go via a private credit fund. APG can say, I can make directly a loan to a big company. I can make a loan to Air France. There's no problem. So yeah, I think that from the 21st century turn with these mega asset owners, with these large pockets of money, I wouldn't phrase the trade-off this way. I would say there is a third route.
Well, let me challenge you a bit here. Aren't we just moving the indirect control? In other words, instead of having lots and lots of diversified investors directly investing in a company, now we have an intermediary, a private equity fund with lots and lots of investors. But then there's still the principal agent problem between investors and the private equity managers. Aren't we back to the same problem?
So I agree with you. I was being a bit cheeky for the sake of the argument. I think that if the point is, are we seeing a convergence of public and private markets anyway? The answer is yes. The only difference with what you're describing is we don't need the continuous trading part of it. But I can very well imagine that the NYSE and other stock exchanges will increasingly facilitate the exchange or over the counter of pieces of private companies, of buildings and the like, in a discrete way. It's just they won't be so obsessed about having it every millisecond. They would say, once a month, every 6 months, there will be one building coming up. We will cut it into 1,000 pieces and we'll sell each piece of this building to institutional also, or whoever intermediaries. And you are right that these principal agent problems, we should not be naive. They haven't been moved. They have just changed place. And the principal agent problems between the LP and the GP in a private equity setting are very big. I've always said that. I'm glad if more people understand that now, but for a long time, this was really put aside and not really talked much about.
Well, Ludo, let me take the other side now. Investors in private equity firms spend a lot more time monitoring the managers than individual investors did. Most individual investors did monitoring firms. In a sense, we're going back to a time before diversification where individual investors held much fewer companies and spent more time controlling those companies. So in some sense, this new mechanism is a return to a more direct link between ownership and control.
Yes. And the slight no would be, or big no, would be that there are now multiple layers of agency behind the person. So in the old days, it was this person owns money. And so that roughly maybe they were acting on behalf of clients, but there was not many layers of money. Here, what we are talking about is that you would have a KKR being the direct shareholder. Then KKR has APG as an investor in it. ABP, a pension fund, is actually the client of APG. And then myself I have my pension, some of it with APG. And so you have a lot of layers of people behind it. And with the monitoring that is not completely trivial. And today with the increase in retail products like these semi-liquid funds, you can have, the semi-liquid vehicle behind KKR, and then you have a feeder funds at the bank, and then you have a client of a bank. So until you move to where the end principle is, it's quite far away. And so this monitoring gets a bit tricky pretty quickly. And there are all kinds of other incentives, principal agent frictions at every single stage, which means that, it's not going to be a world where you would really have a big shareholder with their own money and they have only a few stocks and are paying attention to what the company does. I would think it's a bit different. The multiple layers of agencies, I would say, is the key differential.
So, Ludo, one thing that fascinates me is these very long-term, slow-moving trends where we have long periods where public markets are dominant, and then suddenly, gradually, we see the return of private equity. And I think that in the discussion you just had with Jonathan, several issues already came up in terms of what the product innovation is and what the industrial organization looks like that could be drivers of this. But if you had to describe what are the major forces that are making these long-term trends happen, why is it that suddenly private equity and actually recently private debt are so back on the agenda, even though 20, 30 years ago, nobody was talking about private debt really, unless, of course, you want to call bank debt private debt, which nobody was calling that. And also private equity, I would say 50 years ago, there were not a lot of people that were even talking about private equity, and everybody was involved with public equities much more, including pension plans and others. What are the major drivers of these big secular trends that we're observing?
So a couple of observations maybe before I go into a main argument. The first thing is that you need to be aware, your listeners need to be aware that there is an American distortion here a little bit.
Yes.
Private debt, 80% of the money is in the US.
Yes.
15% in the UK, 5% is the rest of the world, right? So when we say there are 3 trillion in private credits, like almost all of it is the US, right? And then a bit the UK because it's like US BIS, right? The private equity is a bit more dispersed, but if you go out of Western Europe, Scandinavia, UK, US, it's over. There's like hardly any money, except for China in venture capital, which is huge. The rest is zero. Private debt also is a bit different because there has been a bit of a regulatory arbitrage, both for insurance companies that are allowed to lever up positions in private credit in a pretty aggressive way. So for them, there is a bit of an arbitrage there, a regulatory arbitrage. And the banks, because of regulations, have withdrawn from the lending. But again, it's mostly a UK, US thing. And then private credit have stepped in. But in the Netherlands, in France, and so on, there is still, plenty of lending like in the 1990s. On private equity, I have, long ago written about that, and I've listed a number of reasons which I think are still correct. But if we have to narrow it down to one, the main reason, then I would have to refer to a paper by colleagues of Jonathan called Julian Begano and her co-author Siri Vardane at Harvard. They just wrote a piece which I think has the core argument, which is a belief that returns were higher. So I have talked a lot about it, why this belief is actually misplaced and what might have confused people. But if we are really trying to see, the core reason is we believe the returns are going to be higher. Even if we look in the back mirror, our consultants are showing us evidence that it is so. Some prominent academics are saying so. And then private markets is a natural habitat like I just described. So that's it, we're done. We need to put a lot of money in private equity. So I think that's the core reason, is this belief of extraordinary returns. But there is a lot of other reasons, like the CIO of Stanford Endowment, where Jonathan is, makes about $3 million a year. If they replace it by me and I go passive public equity, I'm not going to get $3 million a year, right? So complexity allows people to justify extraordinary compensation, and same for consultants and so on. If you sell as a consultant passive solutions, you won't make any money. So you have an entire ecosystem that is very happy with cooked statistics because that allows them to sell this product. And one thing that people are not aware enough of is that this financial product is the most expensive form of financial intermediation probably ever created. The average private equity fund, LBO fund, charges about, as the best we can calculate, 7% a year in fee. This is orders of magnitudes to any financial products we talk about, right? When we have a debate between active and passive, we're like, oh, passive is 10 basis points and the active has gone down to 100, 700, okay? Like it's out of any kind of range one may think of.
Just to follow up on that, because that can have two implications, right? The first one is we started off the conversation with existential reasons for why private markets can be important and can add value, right? Now there's the other side of the equation, which is it the case that the people that invest in it are overcharged for it? So is your statement that there is a clear place for private markets as long as the fees are commensurate with the actual services that are being delivered?
100%.
Or are you saying that most of private markets could or should be replaced by public markets in any case?
No, so I think the former. And it is important as well, just like I just made the comment on America prominence in this, that the high fee and a lot of issues in private equity is where the main dollars are, which are large leverage buyout groups, usually based in the US. You have tons of people, and if we go to questions about societal benefits of private equity, etc., that are called growth capital, venture capital. Most of private equity in the rest of the world is growth capital. There is no leverage, etc., or hardly any. None of this is controversial. The fees tend to be reasonable for the work done, and so on. So the anomaly pocket is the large LBOs, usually America-based, and this is where they accumulate the issues.
Okay, Ludo, I'm going to challenge you again. My view of fees. Surely a good explanation of why the fees are so high is exactly the question we started with, that the partners and the general partners at the private equity funds are highly skilled individuals who monitor the companies and fix the companies, and that's a skill in very short supply, and they get rewarded for that skill.
So I will accept that argument the day where private equity will be very happy with disclosing all of the fees they charge to investors and to the public, and the end investor will say, okay, I've checked the bill and I'm cool with it. But until that happens, and we're very far from that, then I will have difficulties believing that argument.
Well, Ludo, surely they don't reveal their fees publicly, but I'm sure when the Stanford Endowment is investing in these companies, they reveal very accurately the Stanford Endowment. And so isn't that enough?
Until the mid-2010, all the fees charged on the assets directly wouldn't really be disclosed to even the Stanford Endowment. And I like to think I contributed to that. I documented that a lot of fees were taken directly on the asset, which is a bit of a weird thing, right? It's like I'm controlling a company with your money, and then I'm charging whatever I want from this company that I'm controlling the board of for my own consulting services, for my monitoring, for my transactions. And I decide how much I'm going to pay myself. And I'm your boss, so you will have to sign the expenses and everything. So I documented these things, the SEC went in, etc. So since mid-2010, I think the Stanford Endowment will keep track of the fees on the assets, right? I hope they do it. Where there are still question marks is on fund expenses. I'm not sure everybody gets the breakdown of how much is put exactly on private jets, on traveling, and so on and so forth. I'm not sure all funds expenses are really broken down. And even if the Stanford Endowment is receiving this information, I doubt they are communicating the full amount, again, of fees and expenses paid and communicate that to their boards, or that it goes beyond that. So you have a conflict of interest within also an organization like this, or a pension fund, where the private equity guys know how much they are paying. They can get to the information potentially, but it's not even like that easy. But even when they do, it's not in their interest to communicate it to their trustees, to their principal, etc., because they would freak them out.
You and I both agree the data in private equity is very hard to trust because it's all self-reported. But where I think there is evidence is the performance of university endowments. Despite all of this, university endowments have done exceptionally well. And they have invested essentially a large fraction of their endowments in private equity, which tells me the private equity must be returning more than their fees, or the top funds are anyway.
For sure. We know the numbers, right? The average private equity firm in the past, it's not clear it's going to go like this going forward. The past 20 years, Actually, the last decade and the decade before that is about the same number. It's about 11-12% net of all fees for the average private equity fund. It's even the case if you put like VCs or not in, etc. Recently, Yale released their past 20 years number, and it was 11.5%. CalPERS is at 11%. KKR is 11%. So we know this is the number. This is pretty clear, and everybody is getting about the same number. So you can say, this is enough. And so going, in the past, it was all right. What I have sometimes pointed out is that going forward, if you have lower expected returns because the prices have been high since 2015 and the like, and you're still charging 7% a year, I don't quite see how this is going to fly, right? Because if you have expected returns at 20%, which was the case, actually, these guys are really good. The average private equity fund, for the reasons we started with, have generated 20% gross of his returns, which is extraordinary. It's Warren Buffett's track record for the average guy. But they have charged 7%, and so it's a bit less than 20. So at 7%, they're at about 11 or 12. And so it was okay in an environment where the return on equity has been extremely high. But in a compressed return environment, I'm very worried for when an asset class has such high returns. And we see the tension right now, and we think the NAVs are probably a bit too high. And so it's not clear. And on the returns of endowments, I don't know. I mean, they're good. They are not, I think the average endowment is at 7-8%.
So, Ludo, maybe you could clarify one thing a little bit for me because I'm confused about it. So when a public firm spends money on management, right, there's a certain percentage of the assets that's being spent on those management services too. It just shows up in the accounting statement. It's taken out of the firm. And as soon as the private equity firm delivers those management services, wouldn't it be normal that part of the assets of the firm are paid to that? And shouldn't I try to compare that to the public market equivalent of what is spent on those exact same management services? Or is the statement that the number for the public firm is just way lower than that 7% number that you just mentioned?
So you're putting your finger on a super important point, which fundamentally, for simplicity, I hadn't touched, but we cannot actually estimate the fees and expenses of private equity for that very reason.
Yep.
It's because you can say a public firm has hired McKinsey. I'm not going to count this as a fee. Imagine you're a mutual fund. You hold this company. If the company hires McKinsey, you say, it doesn't count towards a mutual fund fee. Maybe actually the guy is an activist and force you to hire McKinsey, which would be the exact equivalent of KKR saying, well, you need to hire this consultant. It's my consultant and you pay for it. And then it gets counted towards my fee. So that's very fundamental. And that makes the question of fees and expense extremely difficult.
Yep.
So when I quoted 7%, it's actually just the management fees and carried interest. But even that, you could challenge that some of the management fees could be savings of consultants and the like for public companies. The big difference is that you are not allowed when you're a public company to have people who are sitting on your boards engaging in transactions with your company. If you are sitting on the board of company, you cannot appoint yourself as a consultant and saying, this is how much I'm charging, it's arm's length, you really need this advice, right? It's because your conflicts of interest is obvious. So this is where the problem lies, is that to which extent this is arm's length. And if I take the flip side of the story, we see some private equity firms who, for example, would have their internal law team, their internal lawyers, that they're going to charge onto the assets that they're supervising. But it's the legal team or their legal team. It's the legal team that works for fundraising and so on. They would say, but fundraising is for the assets. So I'm charging all the fundraising team, all the lawyers onto the assets. And you're like, but hold on, but you're getting management fees for that. Say, well, management fees is for something else. It's for my Genius monitoring. And so I'm good. And so this is where it gets very complicated. And that's why probably the regulators stayed away from that. But if you look at it from like somebody who's used to public markets, you're like, seriously? Like somebody who's controlling a company can appoint themselves, can pay their own expenses. Like I can go with a private jet to visit a company and say, actually, you, the CEO, I'm your boss, I'm on your board, and you're just going to refund me for my private jet. And you're like, okay, that's weird. There's a governance situation. But this is really, really a fundamental issue indeed, yeah. And it means we cannot measure fees and expenses properly. We will never get to the right answer because we will need a level of benchmarking and details of comparables and of underlying assets of private equity, which would be orders of magnitudes. And so that can answer Jonathan's question. Stanford Endowment would have technically to look at what it would cost to have are these contracts arm's length, the ones that are not arm's length and it's extra fees they have paid, how much is this, and so on. I'm sure they don't make this calculation. They don't want to make that calculation, but that would be the right thing to do.
No, and then on top of that, there is the endogenous selection of who is private and who is public. So it is, in theory, possible.
That's right.
that the places where the management fee is the most valuable is the place that for that reason is private. Although, this comes back to my question earlier too about the trends. I mean, maybe I'm perfectly on board with your argument where if everybody would indeed mistakenly believe that the returns are higher, that will drive a demand for it. That's true. But there are also supply reasons and regulatory reasons and other market infrastructure reasons, and maybe firm management reasons for why we're seeing the division of public versus private that we're seeing in practice.
But in the future, we may see only private markets just buy and hold permanent vehicles,
yes,
or evergreens, but real ones, and versus turnaround situations, right? Everything could be handled by a private market.
So one thing that I think your research has dived into a lot is the question of what benchmarks firms pick. And in the mutual fund literature, Jonathan and I have done quite a bit of work on this as well. And we essentially have come to the conclusion that definitely the benchmark that you pick to hold managers accountable against matters quite a bit for the answer that you get. So for example, in mutual funds, if you use Fama French benchmarks versus Vanguard benchmarks, that actually makes quite a bit of difference. I can imagine that picking correct benchmarks in private equity on the public side, for many of the reasons we discussed, is actually quite difficult. But I also understand from your research that it matters quite a bit what you pick for what the answer is. Is that fair?
It's completely fair. In fact, people often think there is disagreement about the performance of private equity. You will hear this statement very often. There is no disagreement. Everybody agrees it's 11, 12% average. Like, this is clear. All of these agreements come from the benchmarking.
Yeah.
And it's not that complicated, but it is in the interest of people not to understand it. So I'm going to try to say and understand who wants.
Yeah.
So one first thing that is important is that in the 2000s in the US, the large cap had very low returns. So this is the so-called lost decade of the stock returns, etc. If you look at Fama French decile portfolios, all 9 decile portfolios by size have normal returns except the largest decile one. So it's really an anomaly of a magnificent 10 or whatever that they had a bad 2000. Okay. So what that meant is that people used S&P 500 as a benchmark for everything in the 2000s. If you invited anybody in your courses in the 2000s, whether it was for hedge funds, for whatever, it was S&P 500 as a benchmark, okay? And so it's comparing apples and oranges. Private equity invests in small and mid-cap companies. S&P 500 was a completely different type of things. And so I said that. I said to people, look, it's apples and oranges. It just happens to be a low benchmark, but like you're comparing things that are not comparable. And people were very clear in their answer. They told me, we are talking about senior academics. They said, well, you need to see that an institutional investor can only invest in large caps. So the right benchmark is S&P 500 and not like this small cap, but this is outside of their scope. This is the wrong answer, but this was their answers. Then after 2008, S&P 500 does well. It does a bit better than mid-cap and small-cap, not a huge lot better, but does better. And then suddenly the S&P 500 disappears from the radar. Nobody uses it as a benchmark anymore because there is this magnificent 7 and it's unfair and blah, blah, blah. And so it's out. And so they replace it by MSCI World. Okay. And MSCI World is low enough. Good. So now we all beat MSCI World. And so you see the academics, you see the consultants using these benchmarks and to show what, that private equity does better. But it's not that hard to correct. If you compare a US private equity with a US mid-cap, small-cap benchmark, you're not far from one another in terms of returns. The other thing that private equity does is that they do this extraordinary thing where they take out industry sectors from the private equity space. So they say, utilities, real estate, oil and gas, we're going to call this real assets. It doesn't count as an LBO, it's real assets. And you're like, how come? It just turned out to be the 3 sectors with the worst performance over the last 20 years. So you use them in the benchmark portfolio, but you take them out of a private equity one. So you have these tricks that can help you with US against US comparison. But when you do already just US comparisons, it's hard to find that private equity was really above. The big difference is in Europe. Private equity in Europe has much better returns than European stock markets. That's not because private equity is particularly good in Europe. They have the same returns as in the US. But the European stock market have very low returns for the last 10 and 20 years. Why is that? Well, the biggest stocks in Europe is banks, oil, and the like. And these are sectors who haven't done well, even on the US stock market, right? And so when people say, oh, the European stock market hasn't done so well, it's just a different industry mix. And so people should just correct for industries. And we don't have quite the level of data to do that. But whenever people have done a bit of industry adjustment, even rough, you find that private equity and public equity are doing about the same. So when you have an endowment that says, I'm looking at private equity and I'm looking at public equity, private equity did much better, is because they are comparing a US tilted, tech tilted portfolio on the private equity side to something that is basically MSCI World on the public equity market, which has a lot of European stocks, has a lot of oil and gas, has a lot of banks and so on. So they are comparing apples and oranges and then always conclude that our oranges are much better, but it's a very weird and sad situation. So it's not super challenging to do it already to a level where you would get a much cleaner picture than what you get at the moment. At the moment is like the amount of gaming and cooking is just beyond anything.
Well, Ludo, thank you so much for coming here. I thought what you had to say was very insightful. I think many of our listeners are unaware of the details you told us about today.
Yeah, it was great, Ludo. Thank you so much.
Thank you. Thank you for having me.
Thanks for listening to All Else Equal podcast. Please leave us a review at Apple Podcasts. We love to hear from our listeners. And be sure to catch our next episode by subscribing or following the show wherever you listen to your podcasts. For more information and episodes, visit allelseequalpodcast.com or follow us on LinkedIn. The All Else Equal podcast is a joint production of the Lauder Institute at the University of Pennsylvania and the Graduate School of Business at Stanford University, and is produced by University FM.